Welcome to the Daily Drawdown, where AI financing, bond yields, and market rotation set the agenda. The AI trade is moving from a chip demand story into a financing, power, and execution story. That shift matters because higher yields and weaker disclosure can change the economics quickly. Nvidia is building far beyond the role of GPU supplier. It's selling integrated systems, moving into models and software, hiring heavily for model work, licensing technology, and reportedly considering investments across the AI ecosystem. The aim is a deeper customer moat. Hardware, financing, supply chain support, land, and power can bind a data center project more tightly to Nvidia's platform. Pricing is part of the strategy. Reports point to system price increases of roughly 15 to 17% on products shipping early next year, supporting analyst expectations for gross margins in the mid-70% range. The pressure point is disclosure. Financing backstops, private credit structures, and direct investments raise clear questions about counterparty concentration and how much reported demand depends on vendor-supported capital. Investors heading into earnings will focus on durable guidance, margin resilience, and financing exposure. Nvidia has frequently sold off into earnings and delivered negative post-earnings reactions in 6 of the past 8 quarters. AI infrastructure increasingly depends on debt and bespoke financing. That makes the build-out more sensitive to Treasury yields, project delays, and whether customers can turn enormous capex into revenue. Critics see a circular demand risk when vendors help finance customers that then purchase their systems. The demand can be real, and the credit exposure can still become painful if projects are downsized or monetization falls short. GPU residual values provide some support. Hyperscalers often keep systems for roughly 6 years, while used Hopper systems can retain around 60% to 70% of their original value 3.5 years after installation. That creates a meaningful secondhand market for inference and lower-tier workloads. It also leaves lenders exposed to intense usage, component failures, and scarce spare parts that can sharply reduce resale values. The semiconductor sell-off is also an earnings catalyst problem. Once Nvidia and a few major names report, the group faces a 4 to 5 week stretch with fewer broad catalysts. Memory costs are rising, with some reports showing high bandwidth memory prices roughly doubling. Longer lead times ranging from about 6 weeks to nearly 40 underline demand and intensify questions about supply durability. Further upside now needs monetization evidence alongside capex announcements. The central debate is whether this remains an elongated chip cycle or a secular growth transition with a much longer runway. China adds another variable. Its push toward open-source models and improving domestic chips could pressure demand and pricing for Nvidia's highest-end systems over time. The bond market remains the broader constraint. 10-year Treasury yields around 4.7% to 4.75%, have held near levels that weigh heavily on long-duration equities, and 5% remains the psychological line markets are watching. Treasury holds a large cash buffer, estimated around $950 billion to $1 trillion, and has raised planned buyback activity from $2 billion to at least $4 billion in one announced step. Buybacks can improve long-end liquidity and calm the curve. They are a tactical bridge, while fiscal sustainability remains the underlying issue. A larger intervention could also complicate the Fed's independence message. Watch whether officials signal further action and whether yields respond without a renewed inflation scare. Data center plans are running into permitting delays, grid constraints, water issues, and local political opposition, especially in fast-growth markets such as Texas. For developers and real estate investors, contracted power has become a core measure of project quality. Power certainty improves construction timing and can strengthen a project's standing when local resistance rises. Public data center REITs such as Digital Realty and Equinix carry comparatively healthier balance sheets than heavily leveraged private developers with large pipelines. Behind-the-meter power can help in select markets, while grid connections remain valuable for redundancy and reliability. This has produced rotation rather than broad risk aversion. Healthcare, financials, materials, industrials, and parts of enterprise software have drawn interest. as investors reduce exposure to contentious data center capex. Market breadth remains constructive in some readings, with roughly three-quarters of S&P 500 stocks above their 200-day averages. That supports a rotational market view. Defensive allocations cited by strategists include utilities, insurers, McDonald's, PepsiCo, and gold. Bitcoin has rallied sharply toward $80,000, though round number resistance and technical warnings leave it vulnerable to profit-taking. Iran sanctions are escalating through what Treasury Secretary Scott Bessent called Operation Economic Outcast. China is the key pressure point, given estimates that it buys roughly 80% of Iran's oil. Oil flow accounting remains opaque because of ship-to-ship transfers, dark transponders, and alternative routes. Markets have treated the early measures as manageable, with constrained accessible barrels and higher logistics costs already reflected in prices. The US-Canada trade dispute also carries escalation risk. Washington imposed tariffs on roughly $20 billion of Canadian exports, threatened a 50% tariff on vehicles and parts for 2027, and Canada plans dollar-for-dollar retaliation beginning September 8. Energy is the sensitive channel. The U.S. relies heavily on Canadian heavy crude and natural gas imports, making energy retaliation inflationary and politically costly. Watch Nvidia's guidance and financing disclosures, the 10-year yields path toward or away from 5%, and whether power constraints slow the data center pipeline. Those three signals will say more about the durability of the AI trade than another headline capex number. That's the brief from the Daily Drawdown. Stay focused on cash flows, power access, and the cost of capital. This episode was generated by Podkey. Create your own at podkey.fm.
Podkey.